Welcome to Accounting Fundamentals. Before we get into QuickBooks, we will be reviewing accounting principles and practices. We're going to go over business finance, financial accounting and processing, the double entry system, charts of accounts and general ledger, accounting methods, adjusting and closing entries. Business finance is a term that encompasses a wide range of activities and disciplines revolving around the management of money and other valuable assets. Financial accounting and processing measures and records business transactions and provides financial statements that are based on generally accepted accounting principles. It focuses on reporting to external parties such as investors and banks. This shows the major differences between financial and managerial accounting. Managerial accounting is for decision making used by internal managers. It focuses on the future, does not have to follow anything, and basically it's to prepare for what's to come for a company and for internally. But financial accounting is to communicate financial position outsiders. It's for external users, it's past oriented, and it has to be GAAP, GAAP compliant, CPA audited. You have to look at quarterly reports, 10Ks, and you have to indirectly affect it. It indirectly affects on employee behavior. The double entry system is a simple yet powerful tool. Each and every one of a company's transactions will result in an amount recorded into at least two of the accounts in the accounting system, debit and credit. The chart of accounts and general ledger are a detailed listing of all the names of the accounts useful for reporting transactions. There are two accounting methods. The cash basis and the accrual basis are the two primary methods of tracking income and expenses in accounting. For adjusting and closing entries, there is a difference. Adjusting entries are made at the end of the accounting period, but prior to preparing the financial statements, in order for a company's accounting records and financial statements to be up to date on the accrual basis of accounting. For example, each day the company incurs wages expense, but the payroll involving workers' wages for the last day of the month won't be entered into the accounting records until after the accounting period ends. Closing entries are dated as of the last day of the accounting period, but they are entered in the accounts after the financial statements are prepared. For the most part, closing entries involve the income statements accounts. The closing entries set the balances of all the revenue accounts and the expense accounts to zero. This means that the revenue and expense accounts will start the new year with nothing in the accounts, allowing the company to easily report the new year revenues and expenses. The net amount of all the balances from the revenue and expense accounts at the end of the year will end up in retained earnings for corporations or owner's equity for sole proprietorships. Thanks to accounting software, the closing entries are quite effortless. The goals for the course are to learn the purpose of the accounting system, understand the double entry accounting system, discuss the difference between the cash versus accrual methods, learn the accounting cycle, understand the chart of accounts, general ledger, and trial balance. Business finance is the same as your personal finance. The terms may be different, but concepts are the same. You still need to keep track of the money going in and going out. In business versus personal finance, your revenue would be sales versus salary and wages. For expenses, it'd be cost of sales, like your inventory, cost of your inventory, versus your work expenses. Then it's your operating costs versus your household and personal costs. For your profit, it's the difference between sales and costs. In personal, it's the savings and amounts invested. Your loss is when costs exceed revenues. For both, your sources of financing are going to be banks or investors. For your cash flow, the receipt of money is the receipt of money generally from sales, whereas it's the receipt of money generally from salary and wages for your personal. For credit, it's the ability to borrow money or buy now, pay later, and that's the same as personal finance. And the sound investment strategies are pretty much the same investments that return an acceptable profit. For your success, you want to increase sales and profits, And also, for personal, you want to just work harder and make more. Financial accounting is a specialized branch of accounting that keeps track of a company's financial transactions. Using standardized guidelines, the transactions are recorded, summarized, and presented in a financial report or financial statement such as an income statement or a balance sheet. The financial statements of a company are used for many different purposes, and it is very important that the information is reported accurately and timely. The financial statements are important statements that are relied on for both internal and external purposes. Internally, financial statements provide management with the information to monitor the progress of their business and make important decisions in the operations of the company. Financial statements must be produced timely and accurately to provide management with necessary information to operate the company. Externally, financial statements provide important information to lenders, government agencies, and shareholders if they are a publicly traded company. If a corporation's stock is publicly traded, the financial statements tend to be widely circulated, and information will likely reach secondary recipients such as competitors, customers, employees, labor organizations, and investment analysts. The timing and accuracy of these financials are important to provide external readers with the information they need to make decisions. Financial accounting is recording financial information, classifying financial information, summarizing the information, and communicating it. As most of you all know, or will know by the end of this, is the general accounting equation. Assets equal your liabilities plus owner's equity. The double entry accounting system keeps the assets, liabilities, and equity in balance. Debits and credits are used to record each financial transaction, and an account is easily illustrated by presenting it in the form of the letter T. Accountants have been using T-shaped accounts for hundreds of years. The debit-credit accounting system. A debit is an addition to an expense or asset account or a deduction from a revenue, capital, or liability account. It appears on the left side of an account. A credit is an addition to a revenue, capital, or liability account or a deduction from an expense or asset account. It appears on the right side of an account. And those are debit-credit rules. The rules of debit and credit are very simple and can be summarized this way. For assets, debit to increase, credit to decrease. For liabilities, credit to increase, debit to decrease. For owner's equity, credit to increase, debit to decrease, just like liabilities. And those are the rules. Assets are on the left of the equal sign in the accounting equation, so they increase by debiting them, according on the left side. Since liabilities and owner equity are on the right side of the equal sign, they are increased by crediting them, according on the right side. All types of accounts are decreased by making an entry on the opposite side from where they are increased. Assets are decreased by crediting them, while liabilities and equity are decreased by debiting them. And those are the basic rules. Revenue accounts are just like owner equity accounts. They increase by crediting them and decrease by debiting. But since expense accounts are on the opposite of revenue, they increase on the opposite side. Owner's equity, revenue, credit to increase, debit to decrease. Expenses, debit to increase, credit to decrease. For revenue expenses, when sales are recorded, the revenue account is increased or credited. When expenses are recorded, an expense account is increased or debited. Revenue minus expenses equals net profit. Net income, revenue exceeds expenses. Net loss, expenses exceed revenue. The net income is added to owner's equity, or the loss is subtracted from owner's equity. Sales invoices, purchase orders, checks, deposit receipts, and other documents that flow through your business as evidence of financial dealings are called source documents. These documents are used to record transactions in your accounting system and must be retained to support the financial information. Like we explained before, a chart of accounts is a master file, is the basic set of permanent information about financial statement categories or vendors or customers or employees that is used repeatedly in the processing of transactions. The chart of accounts master file contains the account names, account numbers, descriptions, and other pertinent information about the required set of accounts that you identify as being necessary for the business. For input to a general ledger system, the recording of transactions for purchases and payments, the recording of transactions for sales and receipts, the recording of transactions for payroll, general journal entries for adjustments and corrections. The posting of amounts to general ledger accounts, the calculation of new balances in accounts, the display of account history, and the sorting and summarizing of accounts for reports are the process of a general ledger. When transactions are posted to the general ledger, the account balances in them are updated and new account balances are calculated. The end result of this work is viewed by producing a trial balance. A trial balance is a list of the ending balances in each account. It is called a trial balance because it should be reviewed on a trial basis before any financial statements are produced to see that the total of all accounts are balanced between debits and credits. This means that the assets equal the total of the liabilities, equity, revenue, and expense accounts. Which brings us to the cash versus accrual method. Whether or not you are recording your financial transactions on a cash or accrual basis is very important and has a great impact on the net income and balances reported on your financial statements. It is important that you understand the differences in cash and accrual basis accounting. Expenses and revenues are recorded when the receipt of services or payment expense occurs. Revenue is recorded when received, and revenues earned in previous months aren't recognized until the cash is actually received. Expenses aren't recognized until the money is actually paid out, even if the expenses are incurred in previous months, and that's the cash basis method. For the accrual basis method, expenses and revenues are matched and recorded at the time the service or sale is provided or when the expenses are incurred. Expenses are recorded in the month incurred, even if the cash isn't paid out until the next month. Revenues are recorded in the month the product is complete or the product is shipped, even if the company hasn't received the cash from the customer. Adjusting entries are accounting journal entries that convert a company's accounting records to the accrual basis of accounting. An adjusting journal entry is typically made just prior to issuing a company's financial statements. Temporary accounts are accounts that will be closed out at the end of the year. These accounts will have a zero balance at the beginning of the new year, and the balances will be recorded in retained earnings, part of the owner's equity. Temporary accounts are revenue and expense accounts on the profit and loss statement. Permanent accounts are accounts that are not closed at the end of the year. These accounts are recorded on the balance sheet. The ending balance of these accounts on the last day of the year will equal the beginning of the balance of the first day of the new year. Closing entries are prepared to bring the balance of the temporary accounts to zero and transfer the net income or loss to the balance sheet. The net amount of the debits and credits in the closing entries for the net income statement accounts is the amount of the income or loss. This net amount will end up in the balance sheet account as retained earnings, part of the stockholders' equity of a corporation, or in the owner's capital account, part of owner's equity in a sole proprietorship. And that concludes accounting part 1.